Hey, good morning, everybody. Today I'm making two trades. Today we're trading AUY and Walgreens. But I don't just want to buy the shares of Yamana and Walgreens this morning. I want to buy options contracts because I'm not really sure on the price direction of either of these, and I'd rather just wait and see if there's more downside. So I think I will be selling puts this morning. If you don't know what a put is, it's when you can either buy a put or you can sell a put, and today I'll be selling a put. What that means is I will be selling the right to buy somebody else's shares at a certain price. So in this case, if you look here at this contract right here, if I sold this contract for 10 cents, I would be paid 10 cents to buy a share of Yamana Gold at $4.50 if it drops below $4.50. If the price of Yamana Gold stays above 450, the contract expires worthless. And the contract it's not for one share, it's actually for 100 shares. So in this case, I'd be paid $10 for one contract. You have to multiply it by 100. So my strategy for Yamana Gold is different than that of Walgreens. And I'll explain Walgreens when I get there. Walgreens is more of a value investment. Yamana, I'm kind of speculating a little bit, where I'm just using the options contracts to try to create revenue for myself and as high of a return as I can. So usually I'm always trading the option contract that is just out of the money. And so out of the money are any of these options here that are in black and not these ones that are shaded right here. Because that's the one that gets me the highest return. And now there's contracts spread out over time. Yamana has weekly contracts. So one that expires October 14th. The monthly here expires October 21st. And then from there you can see a few more weekly contracts and then they go monthly. I like to keep my time valuation short because I like, for me, that gives the stock less time to move in any one direction. And I think I can typically get a higher return on the shorter end of things. So if we look here, we'll do a little bit of a comparison. So let's look at the one that's expiring this week. For the $4.50 contract, I'd be paid, currently the bid is at 1 cent, which is $1. So if I do 0.01 divided by 4.5, I multiply that by 52 to give myself the annualized return. It's an 11.5% return, which sounds very, very good. But if you're willing to take a little bit more risk by going out on the time curve, $4.50 here can get me essentially 10 times as much. And so back over here to the calendar, 0.1 divided by 4.5 times 12. It's 26% return. Did I do that first one right? 0.01 divided by 4.5 times 52. Yeah, okay. So on the monthly contract here, again, a little bit better of a return. And so if I'm able to do a 10-cent contract every month for the next 12 months, that gives me a 26% return. And so regardless of where the stock price is, I can continue to sell these contracts. Now, the one thing you don't want to do is say I do this contract here for $4.50, and this contract gets filled. I have to buy these shares at $4.50, and then the stock drops down to $3.50. I'm not going to be able to get the same amount of return selling a $4.50 contract. because the stock has fallen so far. And if I then got filled selling at $3.50, I would end up taking a loss. And so that's the downside of this trade, and so that's why I'm more experimenting with AUY. It's a smaller amount, $4.68, which means that it's less than $500 for each if I get filled either way on each contract. So that's what I'm thinking there. So I think I am going to execute this trade right here. I like the way it's stacking up. Come over here. I just want to sell one contract for $4.50 put price that expires toward the end of October here. I will confirm and send. All right, and that one went through. All right, Walgreens is the other one I want to take a look at. WBA. All right, we're gonna do a little more depth here because this one's a little bit more important to me. So if we look over here at the chart, let's just start real big picture. 20-year chart. We can look that we are pretty much at a 10-year low here, and each of these candlesticks is a month, and so on the month it looks like we're headed down. If you were to ask me, I think we're headed down probably right down here into this range. You can see that this is the bottom of the volume profile. And so even though I really, really want to buy Walgreens, I'm a little nervous to buy it here when we get a little bit more downside to go. Sure, it's up today by about 50 cents. But, there's a couple things that I think are allowing stocks to rebound today. One, you had such a bad Friday. So you're going to have a little bit of a kickback from Friday. If we actually, let me see here, if I come over here to, I show you guys this US dollar index, and we look at the 1-year chart, obviously you can see right on up, but short term, past 5 days, we've been in a down slump, and the stock market's really been reacting to the dollar. The stronger the dollar is, the more essentially that foreigners have to sell their equities in order to get dollars in order to pay their debts, more or less. And so that puts a downward pressure on the shares themselves. But the dollar's headed down probably because China is currently in the process of selling a bunch of dollars, and I believe Japan is doing the same thing. And so it's putting a little bit of a floor under the dollar. And so, you can see it kind of looks like it's moving sideways. And I wouldn't mind, or I wouldn't expect to not see that for a little while longer yet, maybe a couple days here, while those governments kind of sell their dollars in order to buy the currency, to support the currency. So, they're trying to save their banking systems or their governments. And so seeing a few crises here in even some of the developed nations. You saw it with England, you're seeing it in Japan, Italy, and so we'll just keep an eye on those things. But I wouldn't be surprised to see the dollar rally. If you come all the way back here, it looks like we're headed up here toward the 120 mark. So I wouldn't be surprised to get there. I think that's going to bring a lot of pain, and so you'll see more downward pressure on equities then. So that's why I'm waiting a little bit, and I'm a little bit hesitant. It's honestly why, if you look at gold, sure, it's up, or the amount of gold, it's up today, but I expect that the dollar strengthens for it to pull back. Even though I really like the company as a whole, I expect it to pull back. All right, so let's zoom in a little bit. Let's just look at where's the 1-year chart. Straight down. we've broken below any sort of support here. How far out? 5 years. How far out do we have to go to find the next support? Well, it's pretty much the 10-year chart. Whoops. No, we're below the last support of the 10-year chart as well. And so it's like, what's there holding it up? Well, it's the 20-year chart, and that volume profile ends right around $25. And so maybe a little bit of a bounce here, but I got my eye out there on that $25 mark. So on a weekly, there aren't any bids here for $25. Not the week after that. If we go the week, okay, so on the monthly, there is a 5-cent bid right now for the $25 strike price. And you can understand why. It's only got a 5% chance of actually ending in the money. So you're not going to get a great return on that. Let's just see. All right, so at 5 cents, 0.05 divided by 25. And then we're in the monthly, so we're going to multiply this by 12. It's only at 2.5%. And that really doesn't strike my interest. It's got to be a greater return annually than what I could get otherwise, even just buying treasuries or AAA corporate. If I'm gonna take the risk, I want to get paid for the risk. And so now let's just look out into November. $25 at 27 cents. Let's do the math. 0.27 divided by 25. And then we're gonna do 6 because you'd be able to do 6 of those contracts. Now you're up to 6%, but again, I really don't like it. And so I think what we'll do, if I look at the weekly here, I don't really like any of these prices. Now it gets much better here when you go out 2 weeks. And so here, I want to show you guys something. If I walk over here, just so you know where I'm thinking, if I find Walgreens down here toward the bottom on my buy sheet, WBA, it's got a current price there. So grams model, buy signal, dividend discount model, buy signal, free cash flow looking good, multiples looking good, average value, that's probably a little too high. This is probably one of the models that's really throwing that off. Peter Lynch's model, which I think values growth too much, and I don't think you're going to see a whole lot of growth out of Walgreens. Obviously doesn't like it, trading very close to its book value, but then beta, which is how much it moves in relation to the market, it's very low, so it doesn't move that much, and so I don't expect it to move a whole lot over the course of 2 weeks. Today it's moving 73 cents, which I feel like is quite a bit. So one thing so here's the way I think about Walgreens. Walgreens is a fantastic dividend stock, and right now it's down nearly 40% from its highs. It's at its 52-week low. I mean, we saw it's at pretty much at its 10-year low, and so you could easily say that, hey, this stock's on sale. I want to get it and I want to hold it forever, and that's generally where I'm at. And what I want to be able to do is purchase the stock, get the 5% dividend every single year, plus that 5% or so growth rate that it has, but then also continue to sell call options against it once I'm holding it. So no matter what, I'm happy to buy at this price. I prefer to buy at a lower price, and so if I can use these put options to give myself cash flow now, but then if I get filled, I'm happy to get filled. I can just switch over to start selling call options against it. That's really the goal. And so I'm not too concerned with the price, but at the same time, I don't really want to get filled at $32 if I don't have to. Um, so I think $30, that's right around where the book value is. And so I think that's the one we're going to look at right now. On the 2-week, contract that's 2 weeks out from now, if I do 43 cents, 0.43 divided by 30 times 26. And we're looking at 37% annualized return. That's more than happy. What I want for my options is actually I want a 20% return, in addition to the 5% return of the dividend. So that way it's right around 25%. That's my goal. I don't know if that's possible. I've done some tests. I've been running these experiments on a paper trading account for about a year now. So now we're in the real market, and we'll see what happens. I don't know if it's going to let me fill this. We'll see. I got more money coming into the account, and I don't know if it's cleared yet. So we shall see if it lets me send this. No. Okay, so I'm gonna wait and see if that money clears today. I put it in a couple of days ago, so it's just taking a little while for it to clear. And if it clears, I'll do it today. Otherwise, I'll be doing it tomorrow morning. All right. I don't know that there's really anything else to say. Thank you all for tuning in. We'll see what happens this week in the markets, and I'll be back maybe this week or again on Monday to execute some more trades. We shall see what happens. Thank you, everybody.